Welcome to a beginner's guide to investing in initial public offerings. In the bustling world of investing, there's a term you may have heard bandied about quite frequently, IPOs or initial public offerings. But what exactly are IPOs and why do they matter to you, the investor? Well, in its simplest form, an IPO is the process through which a private company becomes a public one, selling parts of itself to the public in the form of shares. It's a significant milestone in a company's life, often marking a transition from a smaller enterprise to a larger, more established entity. But why should you, as an investor, care about IPOs? The answer lies in the potential for growth. When a company goes public, it's often because they're seeking to scale up, to expand. As an investor, this can be a unique opportunity to get in on the ground floor, to become a part of a company's journey toward greater heights. Of course, it's not all rosy. IPOs carry their own set of risks, and it's crucial to approach them with a clear understanding of these. But fear not, we're here to guide you through this complex landscape. In this video, we'll break down the concept of IPOs, explain their pros and cons, delve into the process of an IPO, and finally, provide you with a step-by-step guide on how to evaluate and invest in an IPO. Our aim is to make the world of IPOs accessible, easy to understand, and less daunting for beginning investors. Remember, investing is a journey filled with opportunities and challenges, and IPOs can be a part of that journey, offering a window into the world of high-growth potential investments. So buckle up and let's embark on this adventure together. Understanding IPOs can open doors to potentially fruitful investment opportunities. Dive into the basics. What exactly is an initial public offering? First things first. An initial public offering, or IPO, is the process by which a private company becomes publicly traded on a stock exchange. It's a bit like a debutante ball for companies where they step into the public limelight for the first time, making their shares available for the general public to buy. So, how does it work? Well, when a company decides to go public, it partners with an investment bank to handle the IPO. The bank advises the company on the best offering price for its shares, and buys a large portion of them. These shares are then sold to investors, which could be other banks, hedge funds, and even you and me. But why would a company want to go public? There are several reasons. The most common one is to raise capital. By selling shares, a company can generate a substantial amount of money, which can be used for various purposes, such as funding research and development, paying off debt, or expanding business operations. Going public also increases a company's visibility and credibility. It puts the company on the map, attracting potential customers, partners, and even talented employees. Plus, it allows the original owners and early investors to partially cash out their stake, realizing a return on their initial investment. However, becoming a public company comes with its share of responsibilities. Public companies are subject to stringent regulations and must disclose their financials regularly, which can be a daunting task. But if navigated well, the benefits can outweigh the challenges. So, in essence, an IPO is a significant event in a company's life. It's a transition from being a private entity, where only a select few could own a piece of it, to a public company, whose ownership is spread among numerous shareholders. It's the moment when a company opens its doors to the public, inviting them to participate in its growth story. An IPO, therefore, marks a significant milestone in a company's growth journey. Like every investment, IPOs come with their own set of advantages and disadvantages. Let's start with the benefits. The first and most exciting is the potential for high returns. Imagine getting in on the ground floor of a company that skyrockets to success. This is the allure of IPOs. You're buying shares at the company's initial price, often lower than where they might trade in the future, providing a significant upside potential. Another advantage is the opportunity to invest in a company's story from the beginning. You're not just buying a piece of paper or a digital asset, you're buying a piece of a company's future. You're betting on their vision, their team, and their product or service. It's the essence of capitalism and a thrilling part of being an investor. Finally, IPOs offer the chance to diversify your portfolio with new, potentially high-growth companies. This can be particularly attractive if you're looking to balance out more conservative, slow-growth investments. But hold on to your wallets, because investing in IPOs isn't all sunshine and rainbows. There are risks involved, and they're important to understand. One of the biggest is the lack of company history. When a company goes public, it's often relatively new and untested. It may not have a track record of profitability or even revenue growth. This means you're taking a leap of faith in the company's ability to deliver on its promises. Another significant risk is overpricing. The company and its underwriters set the initial price, and they're incentivized to set it as high as the market will bear. If the company doesn't live up to the hype, the share price can plummet, leading to losses for IPO investors. Additionally, IPOs can be volatile in the short term. The initial trading days can see wild price swings as the market tries to find the right price for the company. If you're not comfortable with this level of volatility, IPO investing might not be for you. Finally, there's the risk of dilution. After an IPO, companies often issue more shares to raise additional capital. This can dilute the value of existing shares, potentially leading to losses for early investors. So, there you have it. The world of IPO investing is exciting and potentially lucrative, but it's not without its risks. Like any investment, it's important to do your homework and understand what you're getting into. Remember, investing should align with your financial goals and risk tolerance. If you're comfortable taking on more risk for the potential of higher returns, and you have the time to research and understand the companies you're investing in, IPOs might be a good fit. Weighing the pros and cons can help investors make informed decisions. Before investing, it's crucial to grasp how the IPO process unfolds. This journey from private to public is a meticulously planned event with several steps involved. Let's delve into the nitty-gritty of this process, breaking it down from the company's decision to go public to the actual selling of shares. The very first step in the IPO process is the company's decision to go public. This decision isn't taken lightly, as being a publicly traded company comes with its own set of responsibilities and obligations. It's a strategic move that allows the company to raise capital for expansion, pay off debt, or perhaps to leverage the prestige associated with being publicly listed. Once a company decides to go public, it needs to hire underwriters. Underwriters are investment banks that play a pivotal role in the IPO process. They act as intermediaries between the company and the public. Their job is to handle the grunt work, from due diligence, regulatory paperwork, to pricing the IPO and selling the shares. After selecting the underwriters, the next step is due diligence and the filing of the prospectus. The due diligence process involves the underwriters and the company working together to scrutinize the company's operations, financials, and market potential. This helps in preparing the prospectus, a document that becomes the cornerstone of the IPO. The prospectus is a detailed document that provides potential investors with information about the company, its operations, financials, and the risks involved. It's like a report card of the company that's about to go public. The prospectus is filed with the regulatory body. In the United States, it's the Securities and Exchange Commission, or SEC. This filing is known as an S-1 registration. While the prospectus is under review by the SEC, the underwriters start their work on the pricing of the IPO. This is a critical step as it determines the initial price at which the shares will be sold to the public. The underwriters, along with the company, consider various factors like the company's financials, the current market conditions, and the level of interest among investors. They aim to set a price that's attractive to investors, yet beneficial to the company. Once the SEC approves the prospectus, the company and the underwriters embark on a roadshow. This is a marketing blitz where the company's top brass, along with the underwriters, meet potential institutional investors, analysts, and brokers to generate buzz for the IPO. The roadshow helps gauge investor interest and fine-tune the final IPO price. After the roadshow, the final IPO price is set. This price is what institutional and other large-scale investors pay to buy shares before they are listed on the stock exchange. This stage is also when underwriters allocate shares to these investors in a process known as book building. Finally, the much-anticipated day arrives, the IPO day. This is when the shares of the company are listed on the stock exchange and start trading publicly. This day might witness a lot of volatility as the market discovers the right price for the stock. It's also the day when retail investors like you and I get a chance to buy the company's shares from the open market. This, in a nutshell, is the IPO process. It's a journey that transforms a private company into a public entity. It's a process that involves careful planning, strategic pricing, and a whole lot of regulatory compliance. Knowing the process can help investors navigate the IPO landscape more effectively. Understanding how a company goes public can give you insights into what to look for when considering investing in an IPO. It can help you make informed decisions, understand the risks involved, and ultimately, become a more savvy investor. So as you venture into the world of IPOs, Keep in mind this process and use it to your advantage. Evaluating an IPO is a crucial step before investing. Let's dive right into the key factors to consider when evaluating an IPO. The first thing you should look at are the company fundamentals. These include the company's financial health, business model, and competitive position in the industry. It's not enough for a company to be profitable. It needs to have a sustainable source of earnings and a strong competitive advantage. A company's financial health can be assessed by looking at its balance sheet, income statement, and cash flow statement. These can tell you if the company is making money, how it's spending its money, and if it's able to pay its debts. Look for trends in revenue growth, profitability, and cash flow generation. Additionally, check the company's debt levels. High debt can be a red flag, as it may limit the company's ability to invest in growth or weather tough economic times. The business model is another fundamental aspect to consider. Is the company's product or service innovative and in demand? Does it solve a real problem? Can the company scale its operations efficiently? The answers to these questions can give you a sense of the company's potential for growth. Next, consider the credibility of the underwriters. Underwriters are investment banks that help companies go public. They play a key role in determining the IPO price and in promoting the IPO to investors. Renowned underwriters often have a reputation to uphold and are therefore more likely to be associated with successful IPOs. But remember, this is not a guarantee of success, and it's still crucial to do your own research. The market conditions at the time of the IPO also matter. If the overall market or the company's industry is in a downturn, it could affect the company's IPO performance. On the other hand, a strong market or industry upswing could boost the IPO's prospects. Now let's talk about how to read and interpret an IPO prospectus. This is a document that companies must file with the Securities and Exchange Commission before going public. It contains a wealth of information about the company, including its financials, business strategy, and risk factors. When reading the prospectus, pay close attention to the use of proceeds section. This tells you how the company plans to use the money raised from the IPO. Ideally, the funds should be used for growth initiatives like research and development, expanding operations or entering new markets, rather than paying off debt or rewarding insiders. The risk factors section is also critical. Here, the company outlines potential risks that could affect its business. These can range from competitive pressures and regulatory changes to specific challenges like supply chain disruptions or dependence on a single customer. Be sure to understand these risks and consider whether the company has a plan to mitigate them. Lastly, look at the company's valuation. This can be tricky, as many IPOs involve young, fast-growing companies that may not have a track record of profitability. However, comparing the company's valuation to those of similar companies in the industry can give you a sense of whether the IPO price is reasonable. In conclusion, evaluating an IPO involves examining the company's fundamentals, the credibility of the underwriters, and the market conditions. It also involves carefully reading and interpreting the IPO prospectus. It's a complex process that requires a bit of homework, but it's well worth the effort. A thorough evaluation can help investors avoid pitfalls and identify promising IPOs. Once you've evaluated an IPO, the next step is to actually invest. So let's dive into how you can do just that. The first step towards investing in an IPO is opening a brokerage account. You can think of this as your gateway to the stock market. Now, there are many brokerage firms out there, each with its own unique set of features, fees, and customer service standards. So it's important to do your research and find a broker that fits your needs. Remember, not all brokers offer access to IPOs, so be sure to check that out before making a decision. Once you've set up your brokerage account, the next stage is to apply for the IPO. This is where you indicate your interest in buying shares of the company going public. To do this, you need to fill out an application form, which is usually available on your broker's website or trading platform. The form typically requires some basic information like your name, contact details, and the number of shares you wish to buy. Now, it's important to note that filling out an application doesn't guarantee you'll get the shares you want. This is because the demand for shares often exceeds the supply, especially for hot IPOs. In such cases, shares are allocated on a pro rata basis, meaning you may end up with fewer shares than you applied for. The allocation process is where the underwriters, who are essentially the middlemen between the company and the public, distribute the shares. They do this based on a number of factors, including the size of your application and your relationship with the brokerage firm. For instance, larger applications and clients with a longer history with the broker may receive priority. Once the allocation process is complete, you'll be notified of the number of shares you've been allotted. If you've been lucky enough to get the shares you wanted, they'll be deposited into your brokerage account, typically a day before the company goes public. Now let's talk about flipping shares, an often misunderstood concept in the world of IPO investing. Flipping shares basically means selling them shortly after the company goes public, often on the very same day. This is done in the hope of making a quick profit from the initial jump in price that many IPOs experience. However, flipping isn't always as easy or profitable as it sounds. For one, not all IPOs see a significant price jump, and some even fall below their offering price. Secondly, flipping shares can potentially damage your relationship with your broker. This is because brokers prefer clients who hold onto their shares for a longer period, as it gives them market stability. So if you flip your shares too often, you may find yourself at the bottom of the allocation list for future IPOs. In conclusion, investing in an IPO involves opening a brokerage account, applying for the IPO, and understanding the allocation process. It's a journey that requires patience, due diligence, and a bit of luck. But with the right approach, it can be a rewarding way to grow your investment portfolio. With these steps, you can get started on your IPO investing journey. Successful IPO investing requires strategy and foresight. Diving into the world of initial public offerings, or IPOs, can feel like a whirlwind of excitement and uncertainty. It's the thrill of the chase, the opportunity to get in on the ground floor of what could be the next big thing. But as with any investment, it's crucial to approach it with a clear head and a solid plan. So let's delve into some tips that could aid you in your IPO investing journey. First and foremost, let's talk about diversification. You've probably heard the phrase, "Don't put all your eggs in one basket." This wisdom certainly applies to IPO investing. While it might be tempting to pour all of your resources into that hot new tech startup, it's essential to spread your investments across different sectors and companies. This strategy helps mitigate risks and increases the chance of overall success. Now let's discuss patience. Investing in IPOs isn't about making a quick buck. It's about long-term growth. It's easy to get caught up in the initial excitement when a company goes public. But remember, the real value of an investment isn't always evident in the first few days, weeks, or even months. Patience is not just a virtue, it's a necessity in the world of IPO investing. The third tip is not to be swayed by hype. It's easy to get caught up in the buzz when a company goes public. Everyone's talking about it, the media is covering it, and it seems like a sure thing. But remember, hype doesn't always equal success. It's vital to do your research, understand the company's business model, and make an informed decision based on facts, not just sentiment. Another crucial aspect of successful IPO investing is ongoing monitoring. Once you've made an investment, your work isn't done. It's vital to keep a close eye on your investments, monitor the company's performance, and stay informed about any changes or developments. This ongoing vigilance can help you make informed decisions about when to hold on to your shares and when it might be time to sell. Lastly, never stop learning. The world of IPO investing is constantly evolving, with new companies, technologies, and trends emerging all the time. It's crucial to stay informed, keep up with the latest news, and continuously educate yourself about the market. Remember, knowledge is power, especially when it comes to investing. Now, these tips aren't a guarantee of success. Investing always comes with risks, and it's possible to lose money. But by diversifying your investments, being patient, not getting swept up in the hype, monitoring your investments, and continually learning, you can increase your chances of success. Remember, IPO investing isn't a sprint, it's a marathon. It requires strategy, patience, and a willingness to learn and adapt. But with careful planning and a thoughtful approach, you can navigate the exciting, often unpredictable world of IPO investing. With these tips, you can navigate the IPO landscape with more confidence. Investing in IPOs can be exciting and potentially rewarding. As we wind up this enlightening journey, let's indulge in a quick recap of the wealth of knowledge we've accumulated today. We started our journey by delving into the world of initial public offerings, or IPOs. We learned that an IPO is the first sale of stock by a company to the public. It's a fascinating world where private companies transform into public entities, unlocking a plethora of investment opportunities. We then moved on to exploring the advantages and disadvantages of investing in IPOs. On the upside, IPOs offer the potential for significant returns, especially if the company performs well after going public. They also provide a unique opportunity to invest in a company's growth story from the ground up. On the downside, investing in IPOs can be risky. The lack of historical data and the possibility of overvaluation can pose challenges. Next, we unraveled the IPO process. We saw how it begins with a company deciding to go public, followed by the selection of underwriters, the due diligence and registration process, the roadshow, pricing, and finally, the IPO. It's a meticulous process, governed by stringent regulations to ensure fairness and transparency. Our journey continued as we learned how to evaluate an IPO. We discovered that it's not just about the hype or the brand name, it's about understanding the company's business model, scrutinizing its financials, assessing the quality of its management team, and analyzing the price of the IPO. We then equipped ourselves with the knowledge of how to invest in an IPO. We understood that it involves opening a brokerage account, applying for the IPO through the account, and waiting for the allocation. It's a process that requires patience and precision. Finally, we armed ourselves with tips for successful IPO investing. We learned the importance of not getting swayed by the hype, of doing our homework, of understanding our risk tolerance, and of being prepared to face volatility. And here we are. At the end of this educational journey, we're better prepared to navigate the exciting world of IPOs. We've learned that while the potential for high returns is enticing, it's crucial to approach IPO investing with a clear understanding and careful analysis. It's not a game of chance, but a strategic play that requires insight, patience, and informed decision-making. Remember, every investment comes with risks. Always do your homework and make informed decisions. Happy investing.